The title of our these webinars is Ask the Experts. So I encourage you to do just that. Ask Liz questions. To do that, click on the Q&A feature at the bottom of your screen and type in your question. I'll relay it to Liz. If you're watching on Facebook, put your questions in the comments and we'll try to get to those too. Today, we'll be focusing on our Truth in Accounting, latest financial state of the cities, and also how COVID and the COVID relief money affected that. You can find that report at our truthinaccounting.org website. To look at your own cities, go over to our sister website, which is data-z.org, and you can click on the city tab and find your own city, and it just talks about that instead of getting into the long report. The bottom line of the report is even though all 75 cities studied received COVID relief money, well beyond what is needed to cover the COVID expenses, 61 cities still did not have enough money to pay their bills. This debt includes $180 billion, that's with a B, of earned and promised pension benefits and $160 billion of retiree health care benefits that employees are counting on. The worst city, thankfully, was not our home city of Chicago. It was actually New York City. Each taxpayer there has a taxpayer burden of $71,400. That's their share of the debt. In other words, those taxpayers are going to pay future taxes to cover that debt, and they're not going to receive any government services or benefits related to those taxes. The taxpayer burden in Chicago was $43,100. Now, if you're thinking of escaping the cold and moving to Hawaii to get away from the weather and the city's debt, your city's debt, Honolulu was our third worst city. So that might not be the city you want to move to. The last two of our five bottom sinkhole cities are Philadelphia and Portland. Going into the pandemic, we did have 14 states that had more than enough money to pay their bills, including their pension and retiree health care debt. Interesting, they still received federal aid, questioning whether they needed it or not. And only 14 cities went into the pandemic needing money. Only 12 of them came out in good ahead of the game. The best cities, Washington, D.C. moved ahead of Irvine, California to be so D.C. is now our best, we call them sunshine cities. And Irving moved into second place. So that kind of, what happened to, did D.C. really have, and its revenues, and it really have an effect? How much did the pandemic have on that? Lincoln, Plano, Texas, and Aurora, Colorado are round out our top five sunshine cities. And again, you can go and look at your own city at data-z.org. Now, even though our report said that 63 cities needed money to pay bills, now the cities are actually claiming surpluses, even though they have millions, if not tens of billions of dollars of outstanding debt, including that pension and retiree healthcare debt. If you think of the pension and retiree healthcare liabilities as future taxpayer credit cards, the politicians have been racking up charges on those credit cards for years. Now they're saying they have extra money to spend in their pocket while they're ignoring those credit card statements. I'm going to turn it over now to Liz, who is going to help us understand exactly how much money did the cities and the states receive from the COVID relief bills. What could they do with that money, and what did they do with that money? And then after Liz is done, we'll get to our questions, which I don't see we have any. So please start writing them.
Yes, please. We like questions. Thank you, Sheila. And before I kind of do my song and dance on the federal aid money, I just wanted to say I liked the way that you phrased it about Like for New York, the taxpayers, each person has $24,000 in taxes that they will pay. And that's for services already rendered, mostly because that's debt that the state has already, that the city has already accumulated for stuff it's already built or is about to build, or debt related to public sector retiree benefits that has already been accrued. So it's a neat way to put it. And then I also wonder, because so much of that is attributed to pension debt, public pension systems, actually improved over the last year in terms of their funded status. And it's not because governments all of a sudden started dumping more money into them, although some of them have, gotten some better habits since the Great Recession. It's because the stock market went nuts and assets benefited from that. And so that, to me, it was basically the opposite of what I thought would happen in March of 2020, when everything just went, that straight vertical line down on the graph. There were a lot of worries that this would be the thing that does in pensions for sure. But obviously it bounced back to the public's benefit, ultimately, if you're considering retiree debt. So launching into all of the federal aid money that has happened since March of 2020, when it comes to the funding that directly went to states and local governments, we had two big rounds of funding. There was $150 billion in direct money from the CARES Act, and that went to every single state and DC, and large cities over a population 500,000 or more. And that actually left out most of the localities in our country, a lot of counties, a lot of cities. And so those places had to rely on their state to decide how they wanted to share that direct money. And it was direct money with kind of no strings attached, but there were a lot of rules about how these places could spend it. You could not use it to replenish lost revenues. And just kind of, to turn back the wheel a little bit, again, March of 2020, that vertical line down on the graph I mentioned, that was what was happening with city revenue, with all the money that governments usually make. Income taxes went way down, sales taxes went way down, because the world kind of stopped for a little bit. Governments had to adjust. A lot of governments adjusted back when their income tax filing dates, and so that kind of messed up with their budgeting and how much they made for that fiscal year. So there was a lot of weird stuff, obviously, going on in 2020 in terms of what the revenues governments were getting, and then with what was happening with the money they were getting from the feds. That money ultimately, mostly went to health related expenditures. Governments, I said, they weren't allowed to use it to replace lost revenues. And at the same time, they had all of these extra expenses that they weren't counting on, mostly related to public health, but a lot of, payroll related to overtime for workers and that kind of stuff. Like with all of us, what we were doing on any given day dramatically changed almost 2 years ago. It was the same for how state and local governments were operating. So the CARES Act funds mostly went to public health. A lot of money went to payroll to cover, just public safety, public health, that kind of thing. A lot of it also went to aid programs like small business aid, funds for housing assistance, rental assistance payments, that kind of thing. So that money it's basically spent. It's all gone. And it happened quickly because it was the pandemic, but also the federal government put a deadline on when governments could access and spend that money. So it was in quickly and out almost as quickly. Then came the American Rescue Plan, and I'm kind of glossing over. There were some other specific programs that sent more money to schools, more money for broadband, transportation, that kind of thing. But I'm just focusing on the money that went directly to the general funds of states and cities. And so then fast forward a year later, we have the American Rescue Plan. By then, there were a lot of places, particularly counties and kind of mid-sized cities, that were, lobbying Congress and saying, we we barely, we had to jump through so many hoops to get the money that we did get from our state. Give us the money directly. And that's ultimately what the American Rescue Plan did. The fiscal relief funds this time more than doubled. So last time it was 150 billion. This time it was 350 billion, and going straight from the federal government to the general funds of essentially every municipality across the country. So from my little small town of Smithsburg, Maryland, population 3,000, it's getting, it got its direct funding several months ago. It takes longer for the smaller places just because of how it's doled out. But, larger places started seeing the deposit from Treasury, as early as, I'm going to say like early April. And so that money came with a lot fewer strings attached. Now, governments like with CARES, they couldn't use it to pay debt, which is very important for what we're talking about. They can't use it to make pension payments. So they can't use it to wipe away any of the existing debt they've accumulated. What they could do this time that was different is they could use it to replace lost revenues. And the way that direct funding from the American Rescue Plan is structured, it's like a, get half now, get left half later. So governments all have half of whatever their allotment is, and, ranging from several $100,000 to $1 billion, depending on the size of the government. They got half of that now, and it's 2022, I guess. So later this year, they'll get the other half. The idea was that they obviously we're still in the middle of the pandemic. The funding that's coming in now will be spent on response type stuff. The hope is that funding deposit that comes in later can be spent on more forward-looking investments. Like I said, there are fewer strings attached. It's there's a wide berth for what governments can spend that money on. A lot of places now are just looking at revenue replacement and kind of those more really obvious public health related expenditures, investing them in staff in terms of giving workers bonuses for the work they did during the pandemic. A lot of places are looking at using that money to invest in affordable housing, but most of that money is not spent yet. I'd say there's about, I think, 18 billion or so that has been spent, according to a tracker from the National League of Cities and National Association of Counties. But a lot of that is, has yet to happen. So that's kind of the lay of the land. And then as far as revenues went, cities are still, it's, touch and go. And I'd say large cities are the ones that are struggling the most with what the heck is our revenue growth going to look like in the future, because there's this huge population lifestyle shift that we're in the middle of right now with people being able to work remotely. States are actually doing pretty well. And that was, again, a big concern in the pandemic. States mostly rely on income taxes and sales taxes. Well, this pandemic was a recession on the people in our population who could least afford it. And so, what happens in terms of revenue is the wealthier people were still paying just as much in income tax as they usually do, and perhaps even more, because the stock market did so well. So income tax revenue ultimately did not end up being affected by the pandemic. Sales tax revenue actually increased, because instead of doing a lot of things and paying for that, we bought a lot of stuff and paid for that. And when we buy stuff, that's taxed. When we do things, it's not always taxed. So in that sense, states did really well. I remember my state of Maryland was predicting a couple of $1 billion deficit a year ago, and now it's trying to figure out what to do with a huge surplus. And so that's, that's kind of the picture of what happened with the money and what's going on now. And so I'm going to pause there because I know we have some questions from Sheila and hopefully the rest of you.
Yeah. Yes. Thanks, Liz. And we're still hoping for questions. We don't have any yet. So I think people are having trouble finding the Q&A button, which again is at the bottom of your screen. In the middle, there is a Q&A. Just go ahead and click on that, and then you can type in your questions. I can see them, and then I'll relay them to Liz. Just some comments on what you were talking about, which is that the pension plan assets actually went up. Our governor of Illinois yesterday was saying that both the pension plan assets went up and the liabilities went down, which my research showed that that was not true. The liabilities continued to go up, but you were saying that the pension plan's assets went up because the stock market did well. And I found that our largest pension plan, the teachers' retirement plan, I think had 25% return in 2021. But what I think that this highlights, but people don't think about, is the taxpayers' risk in having these pension assets. Because, like I always find it funny when the stock market does poorly and it goes down, a lot of people say, oh, thank God I'm not in the stock market. Well, aren't they really in the stock market because these pension plan assets are in the stock market?
Yes, absolutely. None of us can get away from the stock market, even if we don't technically directly invest in it. And it's not just that; it's the effect it has on states with high incomes, like California during the Great Recession. I mean, it saw something like a 20% drop in its income tax revenue because it has so many high earners and it has that graduated level of a progressive income tax that ultimately, when you rely on a small share of rich people, you're at the whims of at the whims of the stock market, really. And so California's made some changes since then, so it's not so reliant. But that's a long-winded way of saying, yes, we are reliant.
Yeah, and again, if the real estate market goes down, the taxpayer. Right. So once if these markets go down, these pension assets go down, do the benefits still have to be paid, or do those get reduced also?
Yeah, I mean, those are benefits that are promised, and they're constitutionally promised. Governments cannot get out of them. And Illinois is one of the places that has the strictest, most confined kind of constitutional rules around pensions. There was a lot of pension reform after the Great Recessions because pensions really started struggling financially. And, if in that decade you were unable to reduce your liabilities due to reforms, at the beginning of this pandemic, you're stuck with what you got at this point. It's highly doubtful you'll be able to reduce your liabilities through legislating at this point. The only way to reduce them now is by putting extra money in that pension fund.
And then if the stock market does poorly and we don't have this, and then the benefits have to still be paid, then how are they paid if they can't be paid, if that investment income isn't there?
Well, I mean, so pensions are, what's the best way to put it? I'm trying to think of a good comparison, but, thinking about how your mortgage works, we owe however many hundreds of thousands to the bank, but the bank isn't collecting all of that today. We're just paying a certain amount every month. Pensions kind of similar in that there's a set number of retirees. Pensions have this huge bill of unpaid liabilities, but those aren't all due today. What they do have is the checks that they're cutting to people who are retired. So that is a much smaller amount. But to give you, I think Kentucky actually, which is one of them also like very poorly funded, a lot of Kentucky has, this was before the pandemic, so I'm sure it's changed, but it got to a point where it was paying out about $1 billion in benefits to retirees and taking in about $1 billion from employee contributions and the state's contribution. So in other words, cash, like all it was doing was money coming in, money coming out, and that allows very little room for the assets that are actually in the investment plan to grow. Pension plans are becoming other pension plans are becoming cash flow negative as well, because now we have a ton of retirees and not as many workers whose paychecks we're taking a percentage of to put into the fund. So when assets go down, retirees still get paid. what happens is, and they're still paid from the fund, but what can happen if a fund's balance gets too low, if it doesn't have enough to pay those retirees, then it's got to start taking cash from other places to be able to pay that.
And the cash from other places would be either cutting benefits or additional, because the contributions going in there, the quote government isn't paying those. That's a pass through of taxpayers' money. So in essence, the taxpayers of these poorly funded plans are going to have to pay more into contributions. Well, I could go on that topic forever, but we do fortunately have some questions. And I hope let me know if you're asking questions, if you don't want your name read. We have one from Jerry Turner who says, how is all this federal money being tracked? It seems like the states and local governments are good at hiding the ball from, local governments and local watchdogs. So, how is it? And I know part of the answer to this is that I know that one of the cities I looked at, I think it was Boston, it said in their proposal to use the COVID money, they were going to spend $3 million to hire people just to track the money. So how is all of this being tracked?
So I'm actually about to drop a link in the chat for something called the Pandemic Relief Oversight Committee. It's a resource that I've been using a lot in my reporting as of late, and so far it's basically it's the answer to your question mostly. It contains downloadable databases of exactly where governments have spent their money, what category they spent it on, what entity they spent it on. Personal plug here, you can also subscribe to my newsletter because I use this database a lot in my reporting there and share information about what governments spent their money on. Someone from the committee did tell me that this is going to be updated with the American Rescue Act spending as well. So the federal government is tracking the funds, and interestingly, there's a lot of expectations from the federal government on state and local governments to have really, really extensive auditing and tracking of how they spend the money, where it goes, and whether or not their program worked, like how well the money was spent. And there's a lot of rules in both the American Rescue Plan and now the Infrastructure and Jobs Act too, which is not a relief bill, but there's also money going to state and local governments through that. There's a lot of expectations around government reporting on this, and it's actually got some governments pretty nervous because they've never been subject to this kind of level of reporting on spending to the federal government before. So the hope is that this data will be very accessible, but go to that link and check it out. You can spend if you're a data geek, you can spend an entire day nosing around on there and not take a break.
Yeah. Yes, I've been down those rabbit holes myself. Now you mentioned that the states are doing well, and we found that some of the cities again were okay going into the pandemic, have come out good during the pandemic. I wrote a piece when they were debating on giving additional money to the state and local governments and said, well, why don't you do it based upon whether they need the money or not? And go ahead and say, okay, here's the revenue that they were collecting before the pandemic. We have audited financial statements that show that, and compare that to the revenue that they were collecting, and then maybe give them the difference. But they for some reason, Congress didn't agree with me on that idea. I don't know why. So were there a lot of governments that really didn't need the money from the American Rescue Plan, especially the states?
Yeah, I think that word need is, it depends on how you look at it, right? There's plenty of cities that weren't facing a revenue shortfall when the American Rescue Plan happened, and they got that check. But they can certainly spend the money on needed things. So, were city budgets going to explode if they didn't get federal funding? No, for the most part, absolutely not. And even if, places that were really struggling, San Francisco is a good example because it is a small size city that had a lot of people commuting that aren't commuting anymore. And so it's facing some question marks around where it's around its future revenue growth. But still, San Francisco would have been fine if it hadn't, budget-wise, if it hadn't gotten that aid money. But it's in terms of, some of these things we're talking about, these long-term investments. Sheila, I know one of the things we talked about before this was deferred infrastructure investment. Cities and states didn't really get much aid after the Great Recession. And while they're supposed to be separate entities from the federal government, the way that they coped with that, with their fallen revenues and balancing their budgets, was to defer a lot of maintenance, to short their pension plans. So considering this time, did they need it for their annual budget? No, but they could certainly use the money for the public good. So gray area.
Yeah. And now you also mentioned during your comments that the money could not be used to paying down debt and for pension payments. So I assume that the money came with little F's on it, and then none of those little federal dollars could be put into the pension plan. But isn't money? I think some people call it fungible, where so you can't use those little dollars that have F's on them, but then you got tax revenue that you could use. So, for example, Illinois, after they got their federal relief money, shockingly, their unpaid bills went down dramatically, even though they weren't supposed to use it to pay down their unpaid bills. Oh, but I guess they didn't use it, the money that had little F's on it. Is that how they got around that?
That totally is. And it's funny because, given the outcry, I understand the outcry over not being able to use the federal money to replace revenues during that first round of aid. But it's exactly like you said. I mean, you can spend the money on other stuff that qualifies, and then move the federal money over here, take your money out because now you don't need to spend your money, and spend it over here. I mean, it's exactly like you said. You move the pieces around on the chessboard and report on where that federal money went. Yeah, sure, but that doesn't mean that you can't spend other money on what you want.
And again, if we look at this, like I try to look at this as that on a personal level, where I got an inheritance from my Uncle Sam, and and so therefore I have, quote, extra money. Now, should I use that to go on a vacation or buy new clothes or something, or should I use that to maybe pay down my credit card debt? Should the cities be, I was, initially I was with everybody going, well, they shouldn't be paying it on, the federal government shouldn't be giving the states and local governments to pay down their pension debt. But now I'm sort of like, well, since they, quote, have extra money because they really didn't need all of this money, now they're using that extra money for, frivolous things. And it would be better to pay down. Wouldn't it be better to pay down the pension debt than to spend it on one-time, quote, gifts to the voters, or even worse, to start new programs that once the federal money is going to run out is going to be a problem.
Mm-hmm. Yeah, I mean, I'm not so much concerned about government spending money on something frivolous but I am concerned about what you just said. I mean, the idea of starting a program using temporary federal funding to pay for it, if you're going to do that, but your plan also has to include how you're going to pay for it after 2026 when you're not allowed to use federal money anymore. So that's my big concern. And there is another kind of related aspect of it. there's a big employment crisis going on right now, particularly in local government. More workers are leaving. They lost about a million people at the beginning of the pandemic. They started building that back up, but then, at the beginning of this year, that number started going down again. So people are leaving, they're retiring, they're quitting, they're going to private sector jobs, much of what we've been hearing in the private sector as well. So governments can, according to the Treasury, the Department of Treasury, they can use their American Rescue Plans to rehire people, to retain people, but and when they rehire, they can hire more workers than they had at the beginning of the pandemic. The intention is to help out those places that already had a staffing crisis. But my concern is that now you're really setting yourself up when you consider payroll, retiree benefits, and all of those other things that go with hiring a new employee. Now you're really adding this long-term expense using federal funds. So that in my mind is something to watch for. Governments either sunsetting those positions or having a plan for how to pay for them after the aid is up.
Now, one thing that at Truth in Accounting, we're concerned when the housing market crisis happened, and then the banks got, quote, bailed out, which eventually the banks paid out. But do you think it set up a mindset that, well, if I get into trouble, then the federal government will come in? So, will it prevent cities and states from setting up rainy day funds, because they'll just go, the feds will always come in and help me out if I get into trouble?
I don't think that that's going to happen. I think that the Great Recession kind of shamed a lot of governments into better financial practices. The 2000s were this like crazy time of rapid growth, and it's like, throwing money, making it rain all the time. That's what it seemed like. And then the financial crash happened, and governments realized, on the whole, that they hadn't been truly prepared for something that devastating. And for example, I have this somewhere. I told you I took copious notes, and now I can't find the stat I wanted to use, but here it is. And this is just on the states. When the Great Recession hit, states had an average of about 17 and a half days worth of money that they could run on 17 and a half days and keep the government open with the money they had in their rainy day funds. They spent the last decade building those up because they didn't want 2008 to happen again. When the pandemic hit, states on average had about 31 days worth of spending in the rainy day funds. And they did dip into them. Some dipped all the way down. Nevada cleaned its out. Illinois didn't really have much to begin with, so that's
I think they had 18
probably
minutes,
no surprise to you.
an 18-minute rainy day fund.
Yeah. Right now, I wrote it down. They have, I want to say a couple of million, 5 million. So that's probably about 18 minutes. So
maybe even 18.
They did have as high as 200. Yeah. They did have as high as 277 million back in 2016, but they've used that. So I guess long short, I've looked at the latest numbers, and a number of states did dip into their rainy day funds in 2020. A lot of them have put money back in. Probably a lot of them do for this last surplus, they put money back in, even knowing that they were getting more federal money. So that to me says that at least states, and this is true also for a lot of cities, anecdotally, that they want that savings there. They know that it gives them the ability to be flexible because they can't always count on the federal government. The federal government stepped in at this level this time because we had a big administration change. There was an election in 2020. Who knows the next time a recession happens, what's going to be going on in Congress, and state and local governments know they can't rely on that.
Yeah, now I get nervous about discussion of rainy day funds. It kind of relates to my nervousness about surpluses, because if public is told, hey, we have a rainy day fund, we have surpluses, again, that means we have extra money. So California, you probably know better than I did, had the largest rainy day fund, but they don't properly fund their they don't put any money into their retiree health care plan. So it's kind of like me, again, saying I have money in my savings account for a rainy day, but I have large credit card debt. Is that a good analogy?
Yeah, I think it is. And it's about that mindset of, they've got time to pay off, to build that pension fund back up, because they know that they certainly have more than enough in there to cover the annual payments to retirees. And the thought process is that they're slowly building that back up to where it needs to be, to pay for all of the benefits they promised. Whereas the rainy day fund is who, especially these days, who knows what could happen next month. They're going to need that money more immediately, probably, than they will, in terms of having to face that retiree liability. So it's just about kind of hedging your bets in that sense.
Yeah. I'm just more worried about the optics. I think that's what they call it, of just,
Yes.
of, oh, well, California's doing great. They have a surplus. They have a rainy day fund. We have all this extra money. Let's go ahead and spend it instead of using it for our pension and retiree healthcare debt.
Yeah.
Back to questions. Let's see. Oh, okay. Back to questions from our audience. Sylvie is asking, both corporations and individuals are considering or have already implemented long-term changes on how they work. Have local governments made any significant changes in the way they deliver services and benefits and manage their employees?
That's a good question. And the short answer is yes. So as demonstrated by what we're doing right now, a lot of governments moved meetings online. And while governments are open again, there's still a lot of places doing hybrid options. That has ultimately made government more accessible to more people, particularly if you are a parent of working age. The 7 p.m. on a Tuesday night city council meeting, that's when it is where I live. That's like right in the middle of dinner or bedtime, bath time with my kid. I'm not going to be making it out there, but I can much more easily put it up on my computer and keep track of what's going on, and even participate if I want to. So and then translate that to permitting online, more flexible options for permitting, business permit. There's a lot of kind of services that government did for us, or for businesses, that are now online. Certainly, a lot of them are more savvy than others, but I think and then considering remote work too, a lot of governments have instituted more permanent remote work policies than they had pre-pandemic. And that's both a quality of life and a hiring decision as well, because governments, like I said, they're struggling to find people to fill those empty positions.
Yeah, one thing I'm nervous about is, with these quote surpluses, that, again, the government needs money to spend, they think they have money to spend. And are they going to use that to go ahead and hire new employees, but also increase? Do you think they're going to use it to increase salaries? And if they increase salaries, doesn't that also increase the pension liability?
Yes, it does. Yeah. So, and that's kind of the conundrum. Sorry, my internet cut out for about 10 seconds there. So if I don't address any of your question, let me know in case I missed any of it. But yes, when you increase salaries, you're increasing everything else down the line. As someone on the Q&A who's an actuary pointed out, like, this is all kind of mapped out. But that's what happened in the 90s. They increased salaries, or even better at the time, they didn't increase salaries for workers and just increase their retirement benefits without then actually putting extra money into the pension system. So
do most governments, when they do increase salaries, do they go ahead and calculate, say, okay, we're going to give a certain percent raise, and so therefore that'll affect our current budget, but how much unfunded pension liability is that going to add? Do they go ahead and do that, or not?
No, I mean, I have not heard of that being a regular thing, I'll say. I don't want to speak for every single person or government. But yeah, I mean, yeah, they look at how it's going to affect their budget. They look at how it'll affect their next 5 budgets, but they're not going over to the other side and looking at how it affects their retirement liabilities. The pension actuaries certainly are, but that's not a conversation that's happening, from office to office. It's 2 separate equations, generally speaking.
Do you think that should be happening?
Oh yeah, yes, it should. And I do think that is, just to be clear, and that did come up. I mean, mid 2010, so like say 2014, 15, 16, around there, when we were still really in the middle of pension reforms, particularly with city council members kind of taking the charge. Yes, that connection between when we raise salaries, we also increase our pension liability was much more on the forefront because government budgets were still strapped and there was a lot of pension reform going on at the same time. I think it's different now because a lot of places have done the pension reform and kind of moved on, and they're looking at other things. And that does 2 things. It separates the policymakers from that whole kind of longevity thought process. But on the positive end, I suppose if you're a policymaker and a taxpayer, they've reduced a ton of pension benefits for new hires. So it's not necessarily something they have to think about as broadly as they once used to.
Yeah, it reminds me of 2 things. One is, remind me if I forget to mention New Zealand. That's what my second point. But my first point is in the federal government, they went ahead and years ago and offered the veterans what they called TRICARE. And what was going on is if a veteran lived close to a veterans hospital, then they could get services. But if they lived far away, then they were having troubles getting services. So they said, well, we'll go ahead and offer you dental, I can't remember what the TRI is, but dental, medical care at your local facilities. And therefore you can go ahead and get those benefits locally. And there was discussion during the debate about whether to pass this, that this would add maybe about $1 billion a year, which in the federal government is nothing these days to the spending. But 18 months later, when the audited financial statements of the federal government came out, that one piece of legislation had added between, I can't remember if it was 300 million or I think it was $600 million to the unfunded retiree health care liability, which was not discussed during this. That's why we recommend what we call fact-based budgeting, a plug for our fact-based budgeting, which is full accrual calculations and techniques, which they would have to calculate those incurred costs. How much did the unfunded liability go up if you offer this? Then you're going to have to go ahead and fund it in the current budget. And that's what happened in New Zealand. New Zealand has this full accrual calculations and techniques. And the first year they had it in place, their employees wanted a 1% salary increase. And the legislators were like, oh, that's not that much, 1%. Well, they took it over to their version of the Congressional Budget Office, and they calculated how much unfunded pension liability this was going to add. And it was a very large number. And the legislators were like, no, it's only a 1% increase. It's not, how did you come up with this big number? And it's like, well, you offer a defined benefit plan. And if you increase these salaries, it's going to increase your unfunded liability. And the way we do budgeting now, you have to fund that difference now. So they decided not to give them that raise. And then the employees encouraged the government to go to a defined contribution plan so that they could get these raises and it wouldn't affect the unfunded liability. So, that's why that's a plug for Truth in Accounting's fact-based budgeting. But these governments make these, they make these long-term decisions without thinking of the cost. Jim Noteware from Houston has said government's fiscal irresponsibility is so large and so pervasive across governments at all 3 levels. Politicians simply want to give money away and other benefits and services Meanwhile, warnings like our webinar now go unheeded by taxpayer and voters. What can citizens do to restore the sense of responsibility to our public leaders? I'm sure you can answer that simple question.
Yes, I do have a magic wand, actually. But real quick, one of the questions was for me to put my website up in the chat, so it's up there now. Yeah, I mean, I could give you the kind of cliche, well, you know, vote.
Yeah.
But and that is obviously a big part of it. You know, we need to have more elections where more than 10% of people participate, and I'm not, you know, or more than a third of people, you know, participate if it's a federal election year. Presidential election years draw out all the crowds, but the years in between see very little foot traffic, and so that is one thing. But you know, there are other ways to participate in government. That you can write annoying letters, you can show up at meetings. I mean, that's, I guess, the good and the bad thing about democracy is that we do have the ability to reach the people who represent us. But there is really kind of no one pat answer for how do we hold our politicians more accountable. You know, I think that being noisy is a big part of it. You know, but I'm sorry, I don't have anything more reassuring for you.
Well, we have, again, to, you know, plug our work, is, you know, that's why we do our financial state of the states and the financial state of the cities, and also have those each states and each city's financial state. So the financial state of Chicago, the financial state of Houston, the financial state of, you know, Arizona, Alaska is on our website. You can click on it and you can get a PDF. And I would urge people, as there's all these discussion about these surpluses and what do we do with all this extra money, I would urge, you know, people to print that out and to take it to your legislators and say, do we really have all that extra money? And shouldn't we set, you know, some of that aside to fund our, you know, these plans? You know, the people focus on the pension plans, but the unfunded retiree healthcare liabilities. Let me see. Do I have a percent? I can't remember the percentage, but those are. Do governments fund those like they do the pension plans, Liz?
No, generally not. Very few governments actually even put money into you know, investment system to pay for their healthcare liabilities like they do with pensions. So those really aren't funded by the most part. The government's budget for them every year and pay it every year. But the big difference between retiree healthcare and retiree pensions is that pensions are established and protected constitutionally. Retiree healthcare is not. So in most places, it's much easier to change or just eliminate drastically those retiree benefits. For example, you know, Stockton, California, when it went into bankruptcy, it had the sweetest healthcare package in the system. You and your family basically got free healthcare for life if you were a Stockton City employee or retiree. The city in bankruptcy this is like the one place where you possibly can change your pension liability if you go bankrupt. But Stockton chose not to reduce its pension liability. It instead massively cut its retiree healthcare. And so that's why they're not funded as much as pensions, if you can say that pensions are funded. And also to your point, Sheila, yeah, I mean, I was thinking about comparing like Chicago and the taxpayer liability and taxpayers' responsibility for both pensions and the amount of debt that cities have. I mean, if you live in Chicago, you know how much your taxes have gone up, property taxes, sales taxes in the past decade. And that's almost all of it has gone towards trying to get the city's pension system in a better financial state. You know, so that's, if your city has a high amount of debt, don't think that you're not going to see the taxes the same way that Chicago did.
Oh yeah, and I think that you know, I've tried to explain to elected officials that they need to include that the employee compensation package includes their salaries, and that gets included in their current budget because they have to write the checks right now. Unfortunately, these governments do, in essence, cash basis accounting, which is so misleading that the IRS doesn't allow a corporation that makes more than $25 million to use it to file their tax return. But all these governments, including the federal, state, and local governments, use it to do their budgeting. But that allows them to only include their salaries in their budgets, but their compensation packages include this pension and retiree health care benefits. And those things should also be part of the current budget. It shouldn't be that, oh, well, we're going to pay them in future years. So because those workers' compensation package includes those, and those workers are working for current taxpayers. So the current taxpayers should be funding them instead of, there's no reason that when, employee A retires, that the current, and he's not working anymore for the taxpayers, that the future taxpayers should be paying for his retiree health care. And in Illinois, when they did try to do pension reform, and the Supreme Court said no, one thing they'd done before that was to say, okay, well, you can keep your pensions, but if you want to keep your pensions, we're going to take away some of your retiree health care benefits. And unfortunately, the Supreme Court of Illinois said, well, those retiree health care benefits are just as guaranteed as the pension benefits. And I think there are some people who are talking in the questions are saying, well, you're talking about, like our number is $180 billion of unfunded pension liability. Well, we're using the government's what they call the discount rate, which is, the dollar. Okay, I have these benefits I have to pay way out in the future. How much money do I need to set aside today? And how much money, if I set that money aside today, how much is it going to earn? And the governments are assuming that that's going to earn 7.5%. Well, what happens if it doesn't earn that money? Is the liability the right number if they're using that 7.5% rate, pretending that they're going to earn that much in interest?
Yeah, no, if the plans that are still relying on that 7% number, I would be shocked if that ends up working out for them. And that's why you see a lot of places trying to slowly lower that expectation, because it hasn't panned out. It has not been like that over the last 10, 15 years. And so, but what's interesting, to throw another wrench into this whole weird math thing that we're doing, is inflation. So inflation is already happening. And then, we expect the Fed to raise interest rates and all that stuff next year. How is that going to affect salaries, pension earnings, and all of this actuarial stuff that we're talking about? Because there is an inflation is also baked into this whole thing that we're talking about with how pension plans assets and liabilities grow.
Well, also especially healthcare. Doesn't healthcare usually grow at a rate faster than inflation? So if inflation goes up, then these healthcare liabilities. The other thing I find that people don't think about is it hasn't happened recently, but there was discussion of like, well, maybe we should raise the retirement age for Medicare, so the federal government doesn't have as much liability. Well, what does that do to the state and local governments if they raise the Medicare retirement liability age?
It just passes off the liability even more to them. This is something that Dick Ravitch from New York, former lieutenant governor there, has ranted about several times when I've met him in the past when I was at governing. I mean, and he's right. So a lot of plans in state and local government, if the retiree plans, when you reach 65 and when you reach Medicare age, and it depends on the plan, but a lot of them start passing off some of those obligations to Medicare because now the feds are covering XYZ. They don't have to cover the full healthcare package anymore. So if the Medicare age gets pushed back, then state and local governments are now required to cover however many extra years that is for this retiree that they were planning on scooting off at, age 65 and not paying for as much stuff. So that promise doesn't go away. It's just who's paying for it does.
Oh, yeah. And now we have a question of, let me see. The best question I want to ask here is it generally your understanding that government's pension OPEB plans funded status improved for fiscal year 2021? Do you think that happened in many states? The problem is there aren't sufficient assets to cover liability increases despite great returns. Governments also use the high interest rates. I think we talked about that. Did you want to add any more to that?
No, I think we covered it pretty well.
All right. And somebody, Barrett Peterson, who has worked as an actuary, says that the liabilities that I'm talking about of $180 billion for the cities, 75 most populated cities, and $60 billion for the retiree healthcare liabilities is, that if you didn't use those 7.5% rate of returns, that the liability would probably be 8 times higher than what we're doing. So I guess the one question is, why don't you talked about them reducing the liability, that discount rate, and making it so it's not so some people would say unrealistic, so high. What do you think prevents governments from doing that?
Well, when that goes down, the liability goes up, and the pension bill then goes up. So governments have to be able to cover that difference. They don't want to go down the path of what they did in the 90s, which is to just change the numbers on one side, but then not actually have a financial plan to cover it on the other side. So I'd say California CalPERS is a decent example of they have this plan to lower their liability, and every time returns do really well in one year, they use that as their signal to lower their discount rate. So to get closer to realistic, so that those excess returns can kind of help cover whatever that difference the bill is going to be the following year. And the bill is still going to be higher for governments, but the hope from at least a lot of places is that it has been going up and up and up and up and up over the last decade as governments have tried to be cover this. The hope is that eventually it's going to flatten out. It's not going to keep going up so dramatically every single year.
Yeah, and the I could tell a long story, but we're running out of time, of just that if California had talked about lowering the discount rate, but then they realized that, well, yeah, if I lower the discount rate, as you say, the liability goes up and my current contributions go up. And they didn't want to increase their current contributions. So the discussion of being more responsible by lowering that discount rate went away. We want to thank you, Liz, so much for lending your expertise for today. We really appreciate it. And the listeners, thank you for joining us. Thank you for your questions. And I also want to remind you that you can sign up for our morning call, which is a daily newsletter that has federal, state, and local government budgeting and accounting stories. And also we use it to let you know when the financial state of the states or the financial state of the cities, or in the near future, we're doing the financial state of the combined taxpayer burden. So if you live in the city of Chicago, you're not just responsible for the city's taxpayer burden, you're also responsible for CPS, you're also responsible for METRA, you're also responsible for the water reclamation, and your states. How much is that number? So that'll be coming out in May. And of course, we are a nonprofit organization. So on our website and on the morning call is a donate button. So we would really appreciate you doing that. And since we're past 1 minute past 12:30, again, I'll thank Liz, and I look forward to talking to you and our listeners in the future.
Yeah, thanks for having me.